OCBC stock has surged this year, climbing double digits. But the big question is the upside over, or is there still time to buy this blue-chip banking giant? Let's break it down with solid numbers: earnings, dividends, risks, and future potential. Welcome to Durian Finance, the place where serious investors get clear, data-driven insights on SGX stocks. Today's spotlight: Overseas Chinese Banking Corporation Limited, ticker 039.SI. OCBC just closed at 17 Singapore dollars, up over 15% YTD, outperforming the SDI. So let's dive into the facts before deciding if it's still a buy. Disclaimer: this video is for educational and informational purposes only. It does not constitute financial advice. Please do your own research or consult a licensed advisor before investing. Let's take a closer look at OCBC's earnings fundamentals. In FY 2024, OCBC generated 14.47 billion Singapore dollars in total revenue, slightly higher than the year before. Over the past 4 years, revenue has grown consistently from 11.2 billion Singapore dollars in 2021 to nearly 14.5 billion Singapore dollar today, reflecting a healthy compound growth rate of over 9% annually. Net profit attributable to shareholders came in at 7.42 billion Singapore dollars, a minor dip from FY 2023's record 7.52 billion Singapore dollars, but still the second highest in the bank's history. Earnings per share stood at 1 Singapore dollar and 65 cents, virtually unchanged from the prior year, showing that OCBC is maintaining per share profitability despite headwinds. The profit margin was an impressive 54.4%. Meaning more than half of every dollar earned turns into profit. This margin has steadily improved since FY 2021. Pre-tax income also remained strong at nearly 9 billion Singapore dollars, with minimal special charges this year compared to previous years. Notably, income from associates, such as Great Eastern, contributed 1.01 billion Singapore dollars, showing consistent support from OCBC's strategic investments. Overall, despite a very slight dip in net income, OCBC continues to deliver stable, growing, and high-quality earnings, cementing its position as one of Singapore's most profitable banks. Let's break down OCBC's performance across its major business lines. First, global consumer and private banking saw a total income of 5.3 billion Singapore dollars, generating 2.3 billion Singapore dollars in operating profit before allowances, and 2.19 billion Singapore dollars pre-tax. This segment, covering consumer deposits, housing loans, credit cards, and wealth products, remains OCBC's core engine. Next, global wholesale banking led with 6.06 billion Singapore dollars in income and 4.25 billion Singapore dollars in operating profit, contributing 3.45 billion Singapore dollars pre-tax. This strong result is driven by trade finance, corporate loans, and advisory services. The global market segment added 915 million Singapore dollars in income and delivered 557 million Singapore dollars in pre-tax profit through trading, FX, and treasury operations. In insurance, OCBC generated 1.43 billion Singapore dollars, yielding a healthy 1.19 billion Singapore dollars pre-tax profit, highlighting the strength of the integrated bancassurance model. Other income, comprising credit card and treasury fees, totaled 776 million Singapore dollars, surprisingly contributing 1.58 billion Singapore dollars pre-tax, reflecting strong treasury returns and associate income. Taken together, OCBC posted 14.47 billion Singapore dollars in group income, 8.73 billion Singapore dollars in operating profit, and 8.98 billion Singapore dollars in pre-tax earnings. Geographically, about 60% of profit comes from Singapore, 10% from Malaysia, 5% from Indonesia, 15% from Greater China, and the remainder from other markets like Hong Kong and Europe. This multi-segment and multi-regional footprint gives OCBC both scale and resilience, reducing dependency on any single market or product. Now, let's dive into what really makes OCBC a fortress in the banking world, its core metrics. Starting with capital strength, OCBC boasts a CET1 ratio of 17.6% and a total capital adequacy ratio of 19.7%, both far exceeding regulatory requirements. The leverage ratio stands at 7.4%, which means the bank is operating with conservative borrowing, a great sign in volatile times. On efficiency, OCBC shines with a cost-to-income ratio just 39.7%, highlighting excellent expense control. The CASA ratio at 48.9% indicates that nearly half of its funding comes from low-cost current and savings deposits, fueling a solid 2.04% net interest margin, even as rates normalize. On risk management, the non-performing loan ratio is only 0.9%, backed by a strong provision coverage of 162%, a very conservative stance. Its loan-to-deposit ratio of 78.9% ensures OCBC is not overlending, while its liquidity coverage ratio of 299% in SGD provides more than enough buffer for short-term obligations. Lastly, returns remain strong, with estimated ROE around 12% and ROA at 1.3%. OCBC is using its capital efficiently without overexposure. All these indicators show that OCBC is not only profitable, it's also cautious, well-capitalized, and positioned for stability. Now let's look at how OCBC stacks up in terms of valuation. On a price-to-earnings basis, OCBC trades at just 10.25 times earnings, cheaper than both DBS and UOB. The forward PE is similar, at around 10.3, showing that growth is modest but priced fairly. The price-to-book ratio tells a more compelling story. OCBC trades at 1.23 times book, while DBS commands a premium at 1.65. This suggests OCBC offers more intrinsic value for each dollar invested, while its PEG ratio is a bit high at 3.96, indicating that future growth may already be priced in. OCBC is still more affordable when looking at EV/EBITDA and price to sales. Return-wise, ROE and ROA are slightly lower than DBS but still solid, reflecting efficient capital deployment and asset utilization. Where OCBC really shines is dividends, offering a 5.6% yield, the highest among Singapore's big three banks. And with a payout ratio of just 58%, there's plenty of room to grow or sustain that payout. In summary, OCBC is undervalued on nearly every metric, and that strong dividend yield makes it especially attractive for long-term investors seeking stable income. OCBC is fundamentally sound, but no bank is risk-free. Here are the top threats investors should monitor. First, margin pressure remains real. Net interest margin fell from 2.27% to 2.04%, with the bank expecting further compressions as monetary policy shifts. Second, geopolitical and trade risks, from China tariffs to Middle East tensions, threaten regional economic momentum, potentially impacting both corporate lending and consumer sentiment. Reuters. Third, regional growth is softening. OCBC projects mid-single-digit loan growth, driven by slower economies across ASEAN and China. Fourth, credit risk is rising. The bank increased Q1 provisions by 25%, allocating 212 million Singapore dollars, signaling heightened concern over borrower stress. Fifth, climate and nature-related credit risk is emerging. Along with DBS and UOB, OCBC completed a pioneering study on exposure to high-risk sectors such as agriculture and palm oil. Sixth, ESG and regulatory risks persist. OCBC was fined in 2023 for anti-money laundering lapses related to Wirecard and must continue bolstering climate disclosures. Seventh, operational resilience matters. OCBC faced several internet and mobile banking outages in 2023 to 2024, while expanding its AI infrastructure, a digital risk that requires robust governance. Lastly, market and FX risk looms. Currency volatility, sudden oil price spikes, or rate divergence across markets can squeeze profits. Though OCBC has strong capital buffers, high liquidity, and prudent provisioning, these risks highlight the need for vigilance and ongoing management. Let's round this up with a clear summary. After OCBC's recent rally, is it still worth buying? From 2019 to mid-2025, OCBC's revenue grew 36%, translating to around 5% per year, while net profit surged 57%, compounding at 8% annually. This shows OCBC has become more efficient at converting sales into earnings. Looking at valuation, OCBC trades at just 10.25 times earnings, making it cheaper than DBS. But with a PEG ratio near 4, much of its growth may already be factored into the price. On a price-to-book basis, OCBC trades at just 1.23 times, far below DBS at 1.65, indicating undervaluation on asset strength. And the dividend? It offers a 5.6% yield, the highest among Singapore's big three banks, with a payout ratio of 58%, which leaves room for either increases or share buybacks. Applying the Graham formula, the theoretical fair value is around 37 Singapore dollars, while a dividend discount model puts OCBC closer to 25 Singapore dollars based on conservative growth assumptions. So is it still a buy? White heavy check mark. If you're an income-focused investor, yes. OCBC's solid dividend, strong capital ratios, and steady growth make a compelling long-term hold. For those seeking growth or better risk-adjusted entry, aim for a margin of safety price between 16 Singapore dollars and 50 cents and 17 Singapore dollars. In the long run, assuming consistent performance, OCBC's fair value may lie between 25 Singapore dollars and 30 Singapore dollars. In short, OCBC isn't just surviving, it's thriving. And for the right investor, it still offers both income and value potential. OCBC remains a solid buy for long-term, income-focused investors seeking stability and strong fundamentals. It has shown consistent earnings growth, rising dividends, and maintains fortress-level capital strength. The stock trades at just 10 times earnings, 1.2 times book, and offers a 5.6% yield, the highest among Singapore banks. While risks like NIM compression and regional slowdown exist, OCBC's high liquidity, low NPLs, and strong provisions offer solid protection. Ideal entry, $16.50, 17.00, with long-term fair value estimated between 25 Singapore dollars and 30 Singapore dollars. Comment your OCBC view and subscribe to Durian Finance for more SGX deep dives.